Okay. All right, so we are live now, which I don't know what that means. Okay. Hold on, I want to see. Is there stuff? Oh, wait. Okay. Okay. Got that. It took me a minute to learn how to do all this stuff.
Yeah.
Because I think I can see. Can you see who else is in the room? Because it just shows the two of us down here.
Yeah, I can. There's a counter up top, on the right, up on the right-hand side. The numbers popping.
Okay, cool. Yes, I see that. Awesome stuff. All right. Are you ready to go?
I'm ready to go. Let's do this.
All right. I'm going to get this thing started. All right. Well, welcome, everybody. I am Rachel Lawson of Schaefer Law Firm.
I am Josh Lance from Lance CPA Group.
And we are doing an accountant and a lawyer walk into a bar. And we are going to be talking about breweries and planning. We're going to have, this is the first of the 3-part webinar series. So this is part 1, which is starting a brewery. So hopefully everybody is in some sort of a startup phase at this point, or if you're not and you're just really excited about all 3 topics, like absolutely. So, you know, when it comes to just a kind of entrepreneurship in general, my mother, who's been an entrepreneur for about 30 years, has constantly made the comment to me that you cannot do anything in business without your accountant and your lawyer in the same room. So when Josh and I met, we were like, yeah, let's get like virtually in the same room and do this thing. And so that's where this presentation was born. And, you know, the reason why you need to have both myself as an attorney and Josh as a CPA is that legally and ethically, there are things that I have to stay away from and Josh has to stay away from. And so you could be meeting with your attorney and they basically say, that's above my pay grade, or I'm not sure about, you know, some sort of an accounting issue. And you kind of walk out feeling like you only have half the information. Well, not today, everybody, because we're both here. We're both ready to talk through a complete picture of what it's like to start a brewery. And so, as I said before, we're starting out with the first part of this, which is starting a brewery, and we're going to be going into the 5 key areas to consider. So we'll get into that in a minute, but I want to give you a teaser for the other 2. So the other 2 are, the second one is geared towards established breweries looking to grow and scale operations. You know, you have about 1 to 3 years and you're ready to grow your operations. The final one is talking about exit or succession, any kind of major obstacles, changes, hurdles along the way. So Josh, if you have anything to add, we'll jump right into this in a minute.
Yeah, I think that the goal here with these 3 webinars is to really kind of give a good overview of kind of the things that a brewery can go through from start to finish. And ultimately, you know, particularly with the next 2, you know, these are things that you need to think about whether you're a brewery and planning now or you've been in existence, because there are things that are going to come up even through this one where you're an existing brewery where you may run some pitfalls. So we're kind of taking our experience in the industry as we've seen these things and we've seen the horror stories that have occurred and the bad things that happen, and hopefully give you the knowledge that for yourself that you don't run into that issue and that you are you're equipped with the knowledge and the resources to help you make better decisions.
Excellent. All right, let's jump into area number 1. Could I run a brewery? Where should I start? So we considered these 5 areas. So the 5 areas we're going to cover today are intellectual property, and we're going to be focusing mostly on trademark in that particular section. The second is entity choice. So the decision about should I become an LLC, an S corp, a C corp, which one is the best? What's the difference between them? The players. So who is running and managing this brewery, and how are they all, you know, treating each other? Property, leasing or owning property, And finally, regulatory and tax issues. So regulatory meaning your permitting, licensing, and all of that kind of stuff, and any other tax considerations. And both Josh and I are talking about each one of these. So don't think that if you're thinking you're going to listen to me for like 45 minutes of this, that's not, no. We're going to be jumping back and forth because there are both legal and tax issues in each one of these sections. And you really need to think about all of them. And that's why I said that the conversation is going to be a much more holistic conversation because we're both here to talk about these things. So let's dive in to intellectual property. So I'm really going to try not to bore everybody about this. So intellectual property is really three areas of law: copyright, trademark, and patent. While copyright and patent may be relevant to a brewery, for purposes of what we're going to talk about trademark, but just so you know, copyright has to deal with creative works. So an example that would apply to a brewery would be like the copy on your website if you are blogging or things of that nature. Patent would be some sort of a new chemical process or an invention of some kind, which does happen. Josh, I don't know about you, but when we were at CBC, we were hearing about some really, really cool things that definitely fall into the realm of patent. But you know, that's, I think, definitely more of a conversation later on in the life cycle of the brewery. For purposes of what do we need to do to get off the ground, trademark is really the biggest area that we need to talk about. So trademark is a brand identifier. What is it, you know, fundamentally? It's a name, a design, a logo. So think of the Nike swoosh. Think of the Apple logo. If you're sitting around you, you probably can point out a number of trademarks within your vicinity. Any of the large breweries, Sam Adams, Anheuser-Busch, Bud Light, Miller, all of those are trademarks. When you see a bottle of, you know, Sam Adams, you know what that is and who makes it. A trademark can also be a catchphrase or slogan. I have several clients that are in the process now of trademarking slogans. So a perfect example here in Nashville is East Nashville Beer Works. We have trademarked the phrase beer is community. We have filed for that trademark and it should be awarded pretty soon. Bottle designs also qualify. I've put an asterisk on that because it's a very, very limited circumstance and it's very specific. So an example would be the Coca-Cola bottle is actually a designed trademarkable thing. And they were very smart about it because if you look at some of their logos from a few years ago, the design of the bottle, you know, that curvy design is in their logo. So that's kind of how they were able to do it. And a fun story is Sam Adams tried to get their glass for Boston Lager. So I'm sure you're all familiar with how that glass is. It's got kind of that bubble on the top. They tried to trademark that. Trademark office said no, unfortunately. Sounds and colors. Jay-Z has a blue. Coca-Cola's red. Both are trademarked. And actually, Budweiser has quite a few sound trademarks. They have Howling Wolves. They have the Frogs. They have all sorts of things. So, you know, I think when breweries get started, they automatically think, okay, name of the brewery, logo, flagship beers. And those are all great. But, you know, there may be more there over time. You know, another one that comes to mind is Budweiser's new campaign of Dilly Dilly. Dilly Dilly is a trademark of theirs, and they actually sent a town crier to a brewery in North Carolina to read the cease and desist letter, which was absolutely hilarious. I'd encourage everyone to Google it. It's on YouTube. So rights and trademark are called springing rights, meaning when you start using the mark, your rights spring into existence. It's not I file for it and then I now have the rights. If I start using my name on something, I'm using it in commerce, then that means that I have common law rights to it. Now, registration and stuff, which we're going to talk about, is a little bit of a different animal. So that, you know, in order to use your mark at the exclusion of everyone else, you have to register it. So you can go and poke around uspto.gov, which is where you would go to federally register your trademarks. So I actually asked my associate Kelsey, I want to trademark the trademark equation that is in this slide. It's actually more of a copyrightable thing, but in any essence, if you know, understanding how do I get a trademark? What are the things that have to be in place in order to get one? And the answer is you have to have good or service. So if we take like a real life example, so we've got beer. So beer is actually in its own class of trademark. It's class 32, plus your name and or logo, plus use in commerce. Use in commerce means you have had to cross state lines with the product. So does that mean you have to have made a sale? Not necessarily. We have seen if you bring beer into another state for a festival, or you donate it or something like that, that's going to get you use in commerce. Bottom line, you got to cross state lines. Equals are in the circle. Are in the circle means that we have a federally registered trademark. If you just see a TM next to something, it is not federally registered. It is probably state registered, or it's just got common law rights. Can't hit that button. So if you have identified a name or design you want to use, you're going to want to have an experienced trademark attorney, i.e. us, conduct a search of it. So as I said, beer is class 32. If you find whenever any of my clients are like, we've got a new name, we immediately throw it into the USPTO search engine. And if something comes up in the beer class, we're going to tell them immediately, no dice, because it's federally registered. If you find a name that is similar, meaning distilled spirits, brew pubs, restaurants, other classes of trademark, it could be denied because what the USPTO considers, so if you have a similar name that is for a distillery or a wine, for example, they consider those products to travel in the same channels of commerce, and they may deny it because of that. The other thing is, the question I get constantly is, what if we just throw a Z at the end of the name? This is a very common misconception. Trademark infringement is not exact copy. That's copyright infringement. Copyright infringement is exact copy, meaning you infringe something. Trademark is substantial similarity. So throwing a Z at the end of something ain't going to cut it. If and we use a test called sight, sound, and meaning. If it looks the same, maybe sounds the same, and means the same, we've got a bit of a problem. So we want to be careful about that. And that's, there's a lot more. I'm just kind of giving you guys the very, top level gloss 101. Trust me, I went to law school for a long time and have been practicing long enough to tell you that the learning never ends with this stuff. So what do you really need to worry about in the beginning? Brewery name, huge. I'm a huge fan of getting those names, the word marks done. If you have a stylized logo, I'd suggest that. It depends on if the name is incorporated into the logo, if we need to go that far. Slogans and flagship beers. So most of my clients usually start out with 4 to 6 flagships, and we need to think about that. Seasonal and one-off should be searched to make sure you are not infringing on another brewery's mark, but not necessarily registered. So I actually wore a shirt today that was going to be helpful. Can everyone see it says 2 Hop Shakur? So this is one of my clients, Fat Bottom Brewing Company. And this is not a regular beer of theirs. This is one of their kind of one-off special beers. And so we had to go and look to see, fundamentally, is Tupac's estate going to have a problem? The answer is yeah. So we've basically told them, we're going to kind of fly under the radar. If Tupac's estate says you got to stop using the name, then we'll stop using the name. But we're not going to file for it because we really can't. And that's going to cause a problem. We love the name. We love it. And that's a very common thing. Play on, famous people's names, play on words is a very common thing. The one thing I will tell you, if anyone is thinking about naming their beer Junebug, I've had 4 clients ask me that because I live in the South. It's taken. It's freaking taken. Don't try it. Okay. Okay. So I'm going to turn it over to Josh to talk about why do you care about this from an accounting perspective.
Yeah. So in a lot of ways, this is very much a very legal-based topic of getting this right. From a really technical accounting and tax perspective, this is considered an intangible asset. What that means from a tax basis perspective is we have to basically amortize that over a 15-year period. We can't take it all at once. So when you're doing it for your own stuff, the dollar amount's not usually a large dollar amount. But if you went to go buy another brewery or buy a brand or buy their rights, that's going to be a bigger dollar amount. And that's not something we can just expense right away. We're going to have to amortize it over a period of time. So that's one thing to kind of be kind of put on the radar there, because it's not something we're able to deduct, and we can't accelerate it. We just have to kind of take it over that time. The other thing is there's an incredible cost to switching. So in the cases we've had, two of our brewery clients have to change their names because they got a notice from one was from another brewery, one was from a winery, that said, hey, your name is like ours. We have the trademark for it. You need to stop using it. And that's a really expensive proposition to go through, because it's not just, changing some logos out. It's, all of your registrations. It's all of your, if your cans or bottles or anything that your stuff's out there on, you got to switch that out. There's an incredible amount of expense there.
Do they have to pull all their product, Josh, from the shelves? Were they required to?
They'll have to pull product. Yeah, yeah. In one case, they had to pull product, and that's expensive, right? Because now that's a product you're not selling. You got to bring back. You have to relabel, and then get it out there. There was a time, for this one brewery where they were waiting on approval, so they basically had to stop selling beer. And couldn't resell under a new name until they got all their final approvals in there. So that can be an expensive cost. If there's any penalties or things that get assessed to you, those aren't necessarily going to be tax deductible. So you got to watch out for that sort of thing. When we've seen this happen twice, so we've had two clients where this has happened to them. It was very expensive, incredibly expensive to change. So definitely, engage a lawyer to make sure you got the names right. You're not going to have any issues, that you get the trademarks in place, because the cost to switch and cost to go through that is pretty monumental.
So I actually had another thought, and this is all ad lib, guys. This is so live, it's ridiculous. So I have had clients in the past who are really in love with a name, and they want to try to either coexist with another federal trademark, or they want to buy the name from the other brewery. We have just successfully done that. And, this is where you really want to have an accountant who understands this stuff in your corner, because what I suggest is, okay, well, so we're going to go and approach them about purchasing the rights to their name. Well, what does that look like? I mean, what does that amount look like? And that's where you need an accountant to give you some sort of a moving target, because, I mean, there is, the market for it is, well, I want the name and you have it to sell. So it's, how much are you going to pay for it? You could really jack that price up to, God knows what. And that's where I would want someone who understands how how you amortize these things, really coaching me through the negotiation process. So that would be, that's a big deal. And it has happened. I've done it successfully, not just for my breweries, but for other clients. Purchasing, the rights to name.
Yeah, and when you do make that purchase, right, you have to kind of consider what all you are purchasing, and there's going to be some sort of purchase price allocation that goes in there. To the extent that there are things that we can allocate, that we can take, do in a different manner versus, a 15-year amortization, we would want to do that. So make sure you have a good grasp of, okay, what are we actually getting here? And are there ways we can segregate the cost or do different things in there? We'd want to kind of factor that in, because that would help us from a tax advantage standpoint, and utilizing that.
Okay. So now we're moving on to entity choice. Again, not everyone's favorite, most exciting subject ever. I will not, I'm trying to be as exciting about this as possible. I know this is all exciting for you guys. Okay. So because breweries are producing highly regulated controlled substances, the conversation of should I incorporate or shouldn't I incorporate doesn't even factor in here. You're incorporating. Just if you had any question about it, you're doing it. Okay. So every state offers different options. They vary somewhat from state to state, because in all honesty, they're all products of state law. So, but every state generally offers the following three: your LLC, your S Corp, and your C Corp. So I'm not going to go into too much detail about all of these. Again, it's super boring. I'll go to sleep. We're going to start with the most popular, and the entity choice that ends up being the one that we form quite often. And Josh, you'll probably weigh in, and I encourage you to do so if you're seeing the same thing for your breweries as far as setting up entities. LLC is popular, and the reason is it's a hybrid. It's easy to set up and maintain, It has the ease of starting it as a sole proprietorship or a partnership, but it provides all the corporate protection of our corporation. We don't have limitations on who can own interest in it. We can kind of make it whatever we want. And again, every state is going to be a little different in what they allow and don't allow. And I can't speak to every state because that would be impossible. But for the most part, what I'm saying is pretty general across the board. And so if you want to go into what does it mean to be an LLC from a tax perspective?
Yeah. And I would agree. I mean, I would say every single one of our breweries is an LLC. There's not one that, a C corporation or anything like that. So LLC is going to be the most common thing here. Now, from a tax perspective, it's a little interesting in that there's not an LLC tax return that you file. Like you do with an S corp or a C corp. There is kind of this default classification that exists. So if you're just the single member LLC, you're going to be a sole proprietorship. You'll file a Schedule C on your 1040 tax return. So there's no additional tax returns you're filing. You're just going to do that on your Schedule C and report it all there. If you have more than one member, so a multi-member, you're going to file a partnership tax return, a 1065. In both cases here, these are pass-through taxation. So we have basically the taxation of the business being taxed down at its individual member levels. So if I'm a partnership, I'm going to have K1 statements I'm going to give to each one of my members. They got to report that income on their 1040s and pay the taxes there as well. So the tax, your brewery LLC isn't going to be paying the taxes. It's going to be its members, whether it's a sole proprietor or it's a multi-member partnership. The other thing the LLC can do is make elections. So you can say, hey, it's great, I'm LLC from a legal perspective, but from a tax perspective, I'm going to be taxed as a S corp or C corp. They have the ability to do that and file that election there. In a lot of cases, we see breweries who will do that with the S corp election. We'll talk about S corps next. But it's a way for us to have a different tax, the way we report for taxes than what our legal classification states. So that's another option available to us under the LLC.
Awesome. Okay, so S corp. So it's called S corp is kind of the shortened version. It's a subchapter S corporation. So it's a bit more complicated than an LLC. You have corporate formalities. You have a board. You have shareholders. You have to have meeting minutes. These things are typically required for most jurisdictions. Every jurisdiction, again, is going to vary about what is required. There are restrictions. So for an example, in the state of Tennessee, you're limited to 100 shareholders. And all of those shareholders have to be treated exactly the same. They all have to be what we call common stockholders. You can't give anybody preferential treatment or rights or anything like that. So I can say that S corps are not ideal for investors. They don't like them because there's just not a lot of room to give them kind of perks and things like that. So if I encountered a brewery that was formed as an S corp, not by my advice, of course, and then they are looking to get an outside investment, I would convert them to an LLC, which is you can also do in most jurisdictions. So if any of you listening out there are already formed and you're like, oh shit, I'm one of these forms that they said don't do, guess what? It's super easy to convert. It's super easy. Almost every jurisdiction makes it actually pretty freaking easy to do. Okay.
And then with that, so tax considerations, like we said, this can be passed through taxation. As Rachel mentioned, there's eligibility. Another thing that's going to make you ineligible is if you have basically foreign shareholders. So you have to be either a U.S. citizen or a permanent resident in order to qualify.
Can't be a trust in Tennessee.
Can't be a trust. Yeah, you have to be an individual. You can't be another entity as an owner. So it's limited there. Again, with pass-through taxation, we're going to file a 1120S tax return, have K1 statements that come off of that. Those K1s go down to the individual investors, and the individual investors then have to report that income. If you are a more than 2% owner of an S corp, there are some additional restrictions that you get hit with. One of those is you're not going to be able to participate in any fringe benefits that your employees can participate in. So if you're going to offer an FSA or some other kind of dependent care benefits or things like that, those your employees can do. You, as the more than 2% owner, cannot do. So you have a disadvantage there. When it comes to health insurance, you actually have to report any health insurance payments as income on your W-2, which you can take as a deduction on your 1040. But you can't just run it through the business like you would in another situation. One of the reasons why people do S corps is for the self-employment tax advantages. So back to our LLC with our sole proprietor and our multi-member partnerships, not only do they have to pay income tax and all those dollars, if they're active in the business, they're going to have self-employment taxes as well. And that self-employment tax is an additional 15.3% that you have to pay, which is sometimes a shock and surprise to the new brewery owner who doesn't realize that exists. Particularly in cases if you're a partnership and you're paying yourself as a guaranteed payment, that carries self-employment as well. So in S corp, the advantage there is we basically treat the owners like an employee. We pay some of it through a W-2 wage. If they receive any distributions that come through to themselves, those distributions do not carry self-employment tax. Obviously, the payroll wages that they receive are going to have the payroll FICA taxes on there, which are the same thing as the self-employment taxes. So that is a way that sometimes breweries, particularly if they're pretty closely held, they don't have a lot of outside investors. They may go that route if you have the owners working in the business to kind of help on the self-employment tax burden. Another thing that's new here, and this is new for 2018, from a tax perspective, and this is going to be for our S corps and our partnerships and our single member LLCs, is the qualified business income deduction. So they lowered tax rates for the C corps in order to. It's a big, yeah. So they lowered. The C corps have a lower tax rate across the board, but since all the pass-through tax entities pay using individual tax rates, they have been disadvantaged by the lower C corp rates, so they came up with this qualified business income deduction, which basically, at a very, very simple level, is the taxable income that you're reporting from the business. You get a 20% deduction on that. Now, there's a whole string of caveats and things. We could probably spend 2 hours talking about that alone. So that is going to be, particularly with your tax accountant, they're going to have some extra work that's going to have to happen this year in order to figure this out and do it in the right way. And there's also a bunch of new regulations that the IRS implemented or put in place with regards to this that came out late last week. That people are still kind of sifting through and saying, okay, what does this mean? And what now are things qualifying, not qualifying, things like that. So we're not going to go into the weeds there, but know that that's going to, you have that ability to get that deduction. And it's all going to happen at the personal level. It's not going to happen at the S corp tax return level.
So basically what you're saying is that it's best to call your accountant often and early this year before tax time.
Exactly. Yeah.
It's going to be a crazy time.
Yeah, it's going to be a crazy. It's a lot more planning, and you want to make sure that that you are doing the right things in order to get the deduction. And in cases where you're going to get into that phase out area where you have to do separate calculations, you want to at least know what those are and what the impact is, so you don't run into a situation where maybe you're getting unlimited, your deductions can get limited out or phased out, where you could possibly do some things this year that would help bolster that deduction. So yeah, definitely be in contact with your tax accountant, as this is going to be a pretty new thing, and it's going to have a pretty wide impact, but you also have to understand it and how that impact is to your business.
I can say as a single member LLC, I'm excited. All right. So C Corp, we're not going to spend a lot of time because we've already said, it's not ideal. It's the most complex. It's not going to be ideal. And the reason, and I'll let Josh say this, in much more detail, it's double taxed, which, just by proxy, you don't have to be a math wizard to realize with the other ones, I pay it one time. With this one, I pay it twice. Yeah, right. If you want to go into more detail, please enlighten us.
Yeah, so with that, in a C Corp, there isn't that pass-through taxation. So all the taxes of the business happen at the corporate level. The corporation pays it. That doesn't filter through to the individual until there is dividends that get distributed. So where we have double taxation is the business pays income tax on the earnings that it has. After we pay that income tax, we can then distribute that after-tax dollars to our investors via distribution or dividend. So if you own stock in McDonald's or big corporations, you'll get these dividend checks or dividend amounts deposited into your account. you're also taxing those dollars, right? So we were first paying the 21% tax at the corporate level, and then we're taking those same dollars and then taxing them again at 15% or 20%, depending on your own income level. So there is that double taxation. If you run the numbers, you kind of run the same scenario through all the entities. Assuming you get the full qualified business income deduction at the pass-throughs, you're going to be better off there than the C Corp. You're going to pay more. The other thing that of interest there is if you have losses, and particularly if you're brewing planning, you're going to have losses in the early years. The losses at the pass-through entities, we could offset with other income. Get us bigger refunds, utilize it there. Whereas the C Corp, we just take that loss and we just get to carry that forward. And then we have to utilize in the future. So we're not getting the benefit of those losses today. We have to wait until we actually have taxable income to get that benefit. And then there's some additional changes to the new tax law, limitations on interest deductions, and things like that will play into that as well. So like I said, you're not going to we don't have any brewery clients that have C Corps. I'm sure Rachel doesn't have any brewery clients that have C Corps. It's not common in this type of situation because it doesn't make a lot of sense. And the people, typically have your people working in the business or running it are also owners, and it's a disadvantageous tax position to be in the C Corp.
Yeah, and the one question I get all the time is an LLC, an S Corp, a C Corp, which one's going to protect me the best? And the answer is they all are going to protect you equally. You're always going to have that, what I like to call the Great Wall of China of liability protection, again, between you and your personal stuff, okay? Now, when can that wall be breached? You do stupid things, like you have multiple companies and you commingle funds and treat one as a piggy bank for another, or you do anything that the owners of Enron did, okay? We call that piercing the corporate veil.
I think Rachel may have. We lost Rachel. Uh-oh. We have lost Rachel. So what you're saying there is you have piercing the corporate veil. So if you commingle between funds, if you commingle with your personal, you have that issue in place. I think we've lost Rachel here. Maybe. Hold on 1 second. There's a chat there. David said, while we're waiting, will there be resource materials available at the end of the webinar? The answer is yes. So this is being recorded. This will be recorded and saved there. Slides will be available as well. So you have this. You also have our contact information. So you'll be able to get us with any questions or things that you have here. We'll have some time here also at the end here for questions and answers as well. So hold on here while I try to figure out. Let's figure out where Rachel went here. While we wait here, I'll get the slides back up here and presented. Sorry about us. Hold on 1 minute. Oop, that is not what we want to do there. Hold on. Sorry, guys. Just 1 second here. Try this again. There we go. Let's see. I think we may have Rachel back. Maybe.
Can you hear me?
We can hear you. You're back. All right.
Okay. I don't know what happened. Did you hear anything I just said?
We lost everything once you got into the players. So.
Oh, okay. Well, I'll just say that again. It wasn't long. And all right, hold on. Let me.
You want to do? I think I'm presenting right now. So let me. You got it. You're good.
Yes. Yeah, I got it. Okay.
All
right. Hold on. Let me go back. So, did we hear anything I just said here?
We did not.
Okay,
we did not.
All right. I will do it again. So, just the players in a brewery. So. Most breweries are started with more than one person, and the reason is it's extremely expensive to start a brewery. Most people just are not, liquid enough from a cash perspective to go ahead and start a brewery. I have two that are, for their own, personal reasons, are single, member LLC owned breweries that are completely backed by family and personal money. But most of my breweries are multiple owners. Some are mixed with investors, and all of the owners are active. It depends on the situation. But at the end of the day, a business partnership is basically marriage without the sex. Okay, which is a shameless plug for my book, which is called Marriage Without the Sex, An Unconventional Approach to Business Relationships. For all of you that are married, I guarantee you, if you put the stages of your romantic relationship next to the stages of a business relationship, they're oddly very similar. And there is a very high failure rate of business partnerships, just like, high divorce rate in marriage. But I can say this in my research for my book. When business partnerships are good, they are really, really, really good. But when they're bad, they are really, really bad. So, it's definitely a risk going into business with someone else. And my book really goes through a process of really evaluating if this is the right person and the right business to be going into together. So I recommend everybody pick that up. It is meant to be read in 2 hours. It's like enough for from Nashville to Chicago flight, which is, who's not doing that all the time?
Yeah.
All right. Okay. So, a couple things. Need to make sure certain steps are taken prior to you brewing any beer. And of all the things that I talk about today, this is without a doubt, in my opinion, the one I would like to circle and asterisk and star. It's the most important thing. You need to know your partners. One of the things, actually, Josh, you'll see this at CBC next year. I'm planning on making a gigantic sign that says, when was the last time you saw your business partner naked? Because people are just not going to be able to turn away. But I'm not saying the literal aspect of that. I'm saying you really need to know your partners. And just because you were friends with them in a past life or you're their family members doesn't mean that you know how they're going to be in a business situation where their livelihood is on the line. Have the difficult conversations on the front end. What happens if we hate each other? Because I'm just going to save everybody who is listening to this the suspense. You're going to hate each other within the first 6 months. It's absolutely going to happen. Get a prenup, which is a tongue-in-cheek version of your operating agreement for LLCs, shareholder agreements and bylaws for corporations. Make sure you're constantly working on your relationship. For those of us who are married, it's everyday work, every single day. And the same is true for your business partnership. You got to be checking in. You got to make sure you're communicating. And what to do if things do get rocky? How can we turn the ship around? Using a mediator, utilizing your attorney or accountant, whoever you have that's trusted in your corner, that can help you guys work out some of these, everybody's digging their heels in and we're in a deadlock situation. All right. So as I said, breweries cost a lot of money. And not all owners are flush with cash. Investors are very interested in breweries these days. A couple of years ago, when I first started, banks weren't giving money to breweries and nobody else was getting into the beer game. But it's almost seemingly overnight. People are just going crazy for it. We're seeing it hugely. We've always seen it in distilled spirits, but we are definitely starting to see it more in breweries, which is a fantastic thing because, breweries like yourselves are going to be able to do a lot of these awesome, innovative things you want to do earlier instead of having to figure out how to cash flow it. But of course, just like with business partners, you want to be careful about who you get into bed with. You want to know about their past investing activity. Are they, experienced investors? what are their goals for their investment? If they're a, Uncle Bill, he might just be like, I'm giving you this money, I don't really expect to get it back. But if you've got a savvy venture capitalist who's thinking they're getting like a 20% return on their investment, not sure this is the right thing for them. Make sure capital is readily available and you know where it's coming from. We don't want to get into a situation where we're trying to, launder money through this business. I don't know who would try to do that, but, not to say it's never been done. Okay. So this is, Josh, is all you.
So if you're in a partnership, LLC, S Corp, your investors going to be relying on you to get a K1 statement. So you need to be able to present that to them, get that to them timely. In a case where you have the Uncle Bill, he may not understand what a K1 statement is. He may not understand he's going to get him on a K1 statement. He may not know those things. You make sure you're educating those investors. You may have those investors that are just, this is their first time investing in something like this. Make sure you're educated. Make sure you're educating them. Make sure you educate yourself on what that means for them. When you are, just when you do have profits that you're passing through, that's going to cost tax liabilities for your partners. And so typically business will do a tax distribution to help with that. But know where you're at from a cash flow perspective. If you don't have the cash to do that, you got to make sure to communicate with your investors what's going on there. From a, an ownership perspective, particularly with an LLC in a partnership situation, you have the ability to set things up where you may be allocating a certain percentage of profits to one owner, and the percentage of losses can be different, or those things aren't going to be the same as what their ownership percentages are. So it's important to understand those ramifications. If you're in your legal agreement, you have some sort of waterfall calculation in there. You got to make sure, okay, how does that impact what we are reporting to our owners and how we do distributions from there? So make sure you, as the owners, understand that. Because your investors are going to come to you if you don't have the good answer there. That's not going to instill a lot of confidence in your leadership if you can't tell them, okay, how does this going to impact me as well? And when you do present this information, these K1 statements, you are basically presenting, how well the business is doing. So make sure you are giving that information to your investors through a set of financials, basic balance sheet, profit and loss, and maybe a cash flow statement, so they're understanding what's going on. Good practice is maybe having, a quarterly meeting or an annual meeting, even if you're not required to just go through those things and talk to, okay, here's how we're doing, here's what's going on, here's our plans. Because like Rachel said, you may have the Uncle Bills who are like, okay, I'm just here for the ride. And you may have the savvy investors like, okay, when I'm going to get out. And you don't want to put yourself in a position where that savvy investor forces you to do things that puts you in a place where you have to get them out or have to buy them out, and puts you in a cash flow situation or a thing where now you can't do what you wanted to do before because you have to deal with these investors. So make sure you know your investors and make sure that you understand what their needs and wants are, so you can adequately plan for that.
Yeah, absolutely. Okay, property. So leasing versus owning. So let's just kind of recap. We have figured out the names of the brewery and the logos and the beers and everything. We've chosen an entity. We have come up with an agreement between the owners and investors. And now this is when we start looking for property. Josh, you can chime in here. All of my clients skip right over to this step. But this is number 4 in our list. The way we set this up, guys, is not by accident, okay? This is not the first thing you want to do, but everybody wants to do this first, of course, And I get it. It's the fun, exciting thing. It makes it more real once you do this stuff. Right now we're talking about, a lot of kind of visceral topics. And then once you, sign a lease or, sign, a deed, it becomes a real thing, which is also kind of scary. But we don't want to leapfrog over that other stuff. You got to make sure your ducks are in a row before we get to the house that this is going to be in. So you need to go through all those other steps, all right? I know it's tempting because you might have already found the perfect space and then, it's a hot market and oh my God, well, guess what? If it's meant to be, it's going to happen. If it's not meant to be, it won't happen. I'm a huge, firm believer of that. So, things to look for in a space. Location is obviously important. And you want to think about, what is your business model going to be? Okay. Are you just going to be straight manufacturing and you're going to be distributing right away using distributors or self-distributing, however it works for you? Are you going to have a brew pub? Are you going to be doing tours and tastings? You know, what is it going to look like? Because where you're going to, you know, locate yourself matters depending on what your business model is going to be. If you're going to be having a tap room, and it's a big part of your business, then you obviously are going to need somewhere that has a lot of that front facing aspect in a really high traffic area. And you want to do your diligence. Hire a commercial real estate agent. I can't stress this enough. Don't think you know everything, okay? Guaranteed. Don't try to be either one of us either. We hate that. You know, I hate the attorneys who have become the Google lawyers, and I'm sure, Josh, you hate the Google CPAs. Yeah. So commercial real estate agents, the good ones, are going to be able to help you find the right space. Square footage. Don't forget your ceiling height, okay? Some of these fermenters and mash tuns, as you know, they're kind of big. And if you don't have enough, you know, height going on there, you might be a little screwed in what kind of equipment you can buy, okay? The possibility of expanding footprint. This has definitely become an issue here in Tennessee. For those of you who don't know, the Southeast is probably the fastest growing area in craft beer in the U.S. because we just have a lot of places to go, basically. And I have so many of my clients, I mean, they get into a space and almost like the next day it's too small. And they're already having to deal with, you know, expansion conversations before they've really even started brewing their first beer. It's a great problem to have, but if you can't expand within your current footprint, that could be problematic. You know, most of the people that I know have found workarounds to a lot of this stuff. You know, because obviously the second you know, sign a lease for a space, you know, you've got to think about being in there for a little while. But, you know, in the past year, we've had news stories here in Nashville. Yazoo just put their 10 million, their current building up for sale for 10 million. It has sold and they're moving into a bigger facility. Same thing with Jackalope. Mantra is going to be moving their operations to out in the Steel Barrel, which is on MTSU's campus. So, I mean, it's growing very rapidly. So keep that in mind, that expansion is going to happen, and you got to think about that on the front end. Okay, lease versus own. So yeah, leasing, obviously, we don't own the business. We are basically licensing the right to use it by giving someone else money. If you don't have the money to purchase your own property, then you're probably going to be default into the leasing, you know, situation. But commercial leases are very different from residential leases across the board, every jurisdiction. First of all, a residential lease can, you know, maybe top out at 5 pages. Commercial leases are about 30, okay? So you need someone who is a real estate or has a real estate background to help you understand what you're obligated for. So here's an example. In the state of Tennessee, commercial landlords kind of run the game, okay? They just do. In the state of Tennessee, if something breaks down inside your space, the HVAC, the plumbing, the electrical, it's on the tenant, all on the tenant. Anything that has to do with the exterior walls or the roof is the landlord. And that's just the way it is here. That is how it has kind of fallen into place. And it is going to vary very differently from jurisdiction to jurisdiction. Same thing on owning. And be particular, so you want to make sure that you hire an attorney. The things you want to think about if you're going to buy raw land and build on it, zoning, huge. You want to make sure you're zoned properly for commercial, probably agricultural, who knows? It depends on what you're going to do. So you want to find out about the zoning regulations. The other thing, and I'll let Josh talk a lot more about why we like to do this, but I have a lot of clients that purchase the land under one type of entity and they lease it to the brewery. And that is asset protection. And I think there's some tax stuff, if I'm not mistaken.
That is correct, yeah. You know, so in this ownership situation here where we have 2 separate entities, you know, there's one of the advantages of this kind of creating this rental relationship is, one, we get to take all of our assets, or things we improve that we do inside the brewery LLC, and we get special preferential tax treatment on those things. Versus if we do it and we own the building and we're doing it in that space, we have to take that over a 39.5-year period, and there's no benefits or things. We just get to, we have to hit that up. So, so we get to have a little bit more tax flexibility with the new tax law put in place. This gives us that tax flexibility again, because now we can do some Section 179. We can do some other things that the new tax law now permits for us with a leasehold space. One of the things that we also want to make sure in that relationship too is when we do rent. So in the rental, the property is owned and it's getting rents from the its owner or from its tenant, the Brewery LLC. That is rental real estate income, so it gets treated a little differently. So we just got to make sure we're cognizant of that. We don't want to cause us to have a lot of rental real estate income and have a lot of ordinary loss at a brewery that we can't offset. So we got to make sure we manage that right. So we just had a conversation with the brewery earlier this week where they're in the same situation where it's like, how do we manage that relationship so we're not putting ourselves in a place that's disadvantageous from a tax perspective. So when we get to have that separation there, we get a lot better benefits as a result from a tax perspective, and we can be a little bit more strategic as far as how we deploy some of those and how we utilize that, particularly in the early years, because in the early years you're going to have a lot of taxable losses just arising from the business. We don't want to, burn a bunch of depreciation we don't need to. So we're going to be at, using things like Section 179 depreciation to better manage that. So those are some things we got to consider in that. If we do buy the property and we are making improvements under that, the property LLC, we do want to go through a process of what's called cost segregation. Cost segregation basically starts pulling apart different pieces and allows us to not just take everything over a 39.5-year period, but we can take everything based on, how the thing is segregated. And so you would have a cost segregation specialist come out there, they do analysis, they come up with this report, they kind of show you then, okay, here's how we can now structure this the best utilized for our tax perspective. So, if that is the case where we're just in one entity, or we're going to want to make sure we do pull the trigger on that, because that, again, will give us more flexibility when it comes to depreciation.
Awesome. Okay. So I think you just talked about all that.
Yeah.
All right. Okay. And our final topic for today is regulatory kind of final catch-all tax issues that we haven't discussed already. So regulatory issues, so at this point, we're starting to brew beer. And so we now need to start looking at permitting at the state, local, and federal level. Okay. So every state, I can say this, is, there's very few areas of law that are super, super different per state. Alcoholic beverage happens to be one of them, okay? You're definitely going to want to, if you have any counsel in your jurisdiction that can, wade through the alcoholic beverage laws, that is helpful. If not, there are places that you can go from a state and local perspective. Usually it's regulated under, Secretary of State or Revenue, or some of those areas are the first places to look. Mm-hmm. From the federal perspective, we've got TTP and COLA approval. You've got to get your brewer's notice through TTB, and you've got to get all of your labels and recipes approved for COLA. And the TTB stuff can take a couple months. We're seeing an average of 3 to 4 months on that. COLA approval is a little bit faster, but this is stuff that you need to build into your plan as you're building. All of this to say, this entire process of starting a brewery from idea all the way to, opening your doors and serving your first pint, takes about a year. It really does. Most of my breweries in planning, they're thinking, if they're talking to me now, they're looking at next summer to be open. And because it's just a process, okay? Hire an attorney to practice alcoholic beverage law. There is almost every state will have at least one attorney who does it, okay? I've met several attorneys in different jurisdictions, and we talk a lot to each other because I may have a client who is looking to expand into a different market. And so I need them to understand the laws, and I need them to work closely with that person. So, definitely think about hiring somebody on that regard.
So taxes. So there's a lot going on here when you become a brewery with regards to taxes. So high level, you're going to have income taxes, federal and state income taxes. They may be called different things in different states, but you're going to have that. So, and most people know that part. They get okay, we got to pay income taxes on the business. Beyond that, now we're going to what's the joy of being a brewer is the excise taxes. So things we got to pay at a federal and state level. And this is done at the federal level through Brewer's Report of Operations. You come up with, okay, how much activity we've sold out. We have a price per barrel. State level, you're going to that same thing. One of the things you got to watch out for is the timing of those. So depending on the size of your brewery, you're probably going to start at quarterly on the filing of your Brewer's Report of Operations. But at the state level, that could be monthly. So you got to watch, make sure that you're not missing these deadlines, especially at the beginning, because the states will come after you. If you don't, then you get penalties and interest and things like that that you want to avoid. So we have these taxes based on what, the amount of alcohol that we are producing and selling, which is our excise taxes, sales tax. Again, this is, everything that you sell is going to have a sales tax if you have sales tax in your state. You want to, again, watch for the timing on that. Make sure there isn't any local taxes that are associated as well, depending on your jurisdiction. There may be some local sales tax that needs to be applied, or it's like a food and beverage tax, or, a lot of different local places call differently, but you have to watch for that because that is something that you're going to be required to do. Again, depending on your state, you may have some gross receipts taxes that are due. I know Tennessee does a gross receipts tax. Some other states do that, which is not your income tax. So that's the separate thing that you got to watch yourself for. Make sure we understand that, and then again, watch for local taxes. Particularly local jurisdictions see these things happening, they're going to want to capitalize on it and get a piece of the pie. It's not necessarily going to be called a sales tax or something like that, but you got to watch, make sure, are we getting those things? We have one of our breweries in our town, one of the towns they're in. They opened up their first brewery in the town, and the town decided, hey, we're going to establish a beverage tax that is solely for breweries that operate in our town, which is they're the only one, right? So they created a special tax just for that brewery as they open up. So make sure you're aware of that.
And that kind of thing can happen. It happens all the time.
And make sure you, if you're relying on a tax professional to help you out with this, make sure you understand, okay, who's doing what in the process. But it's really important to get these things in place. There was an instance here in Illinois where there was a brewery who failed to file sales tax returns. On a basis, didn't do it. State of Illinois came out there and said, hey, you should do this. And until you do that, we're going to pull your liquor license. So the liquor license, they cannot operate anymore. And so they paid that tax and got current there. And for them, they did not consult with the tax accountant in this. They decided to do a Kickstarter campaign to pay for the tax. Kickstarter campaign is taxable. So if you do a Kickstarter, any funds are taxable. They then cannot pay their state income taxes, and then they got their license pulled again. So and they stopped. At that point, I think they threw in the towel and said, we don't know what we're doing. We're going to stop here. And so they did not continue on. But that is a thing, particularly because it's such a highly regulated industry, and depending on the state, they do have the ability to shut you down. If you do not pay your taxes, they will shut you down in a heartbeat. So, be super cognizant of this, particularly things like sales tax or excise taxes where it's not something you're used to or known before. Either figure out how to do it yourself, work with a tax accountant, figure out how to do it, but make sure you're staying on top of that because it is something that will cause you to run into issues, and then these issues will just snowball on each other. So you want to make sure you stay out in front of that.
Yeah, and I can say absolutely every jurisdiction has franchise excise in some form or fashion that you can't avoid. I have formed corporate entities in at least half of the states in this country, and they all have it. They all have them. So you really don't want to screw around with this. Trust me, as an entrepreneur, I thought I could do everything myself when I first started too. And then I learned real quickly, I'm a lawyer. I am not an accountant. I am not a marketing person. I am certainly not a brewer. Let's not do these things. So I buy my beer and I put it in the fridge, and I hire accountants and I hire marketing people. So, just keep in mind, you may think that you're coming out of pocket for some of this stuff, but what are you saving on the back end? Probably a lot of headache, possibly legal fees, things like that. All right, so that's our presentation for today. So in a short month, we will be talking about scaling and growing your brewery. So we really hope to see everybody again. Thank you all so much, and Josh, thank you for collaborating on this. It was
Yes.
fun. So I guess we got a couple of minutes. I guess if anybody has any questions, they certainly can use the chat feature to chime in. And feel free to reach out to either one of us if you have a specific question that you'd rather take offline. So I will send out here's my email address. Josh, I would assume you also have the ability to do this. And here is my phone number. So if you would prefer to take it offline and not have it to the group, that's fine. Feel free to ask either one of us. Even if you're not sure, I love questions about you're not even sure if it's a legal or accounting question. We'll let you know.
Yep.
So if no one has any questions at the moment, we appreciate everybody's time, and we'll hope to see you guys in a short couple weeks for our next presentation.
Thank you, everyone.
Yep. Thanks, everybody. Happy brewing.